got just under 3 minutes left of trade. What a roller coaster session it has been. Let's start with a ride on that roller coaster. Looking at the S&P 500 intraday chart, you can see that little bit of positivity we had right at the open. We went green about half an hour into trade. Then a sharp sell-off, negativity, kind of coming in because of some comments in and around China. But either way, we lost momentum, down significantly for most of the session, and then we rallied towards the end of the session, and the S&P is just positive at this stage. If we look next at some of the factors that caused us to be lower earlier in the session, it was very much international factors. China down sharply, playing catch-up, having been closed all of last week. Italy down sharply, not playing catch-up, just down in its own right. Germany down 1.3%, the FTSE 100 at a 6-month low, down 1% itself. But once Europe closed, that is one of the factors that allowed us to rally. Here, bringing in Bob Pisani, we're going to have a look at the sectors as well to see how this played out. It was the banks about an hour and a half ago that started to rally intraday, that allowed the rest of the market to rally. And the financials, as we stand, up about 0.6%. Staples doing well, real estate doing well, utilities doing well. So other than the banks, it's very defensive sectors that have propped us up. Technology once again suffering, Bob, and the Nasdaq is suffering because of that.
So, again, if you take a look at what's moving here, again, you get underperformance from technology. Again, this is the third day in a row now. We're getting underperformance from technology and outperforming from defensive names. A little surprising to see, for example, REITs, maybe, utilities. You think, gee, they wouldn't do better in a higher rate environment, consumer staples, but these can be defensive names, and at least short term, they're outperforming. Here's an unusual thing. Vanguard Utility, very high volume this year, today. S&P 500, value high volume. We've been debating for a long time whether, if ever, value would start to outperform growth stocks. Growth stocks have outperformed for years. Low growth environment, low interest rate environment, you buy growth stocks, you buy anything with growth. But now we're getting different. Somewhat higher rate environment, somewhat higher growth environment. That's a different situation. That's why tech is underperforming, and we're starting to debate again whether value should outperform. This is a tough day to figure out, Wolf, because the bond market's closed. So you're kind of like looking at only half of the market. It's like looking at somebody trying to figure out what they're thinking by looking at their eyes, and they've got sunglasses on. I'll bet you today, if the bond market was open, yields would actually be down today, not up, and that would have helped the market. And that's kind of what the stock market seems to be implying at this point.